Hey everybody, how you doing? It's Brett Popish here with Universal Lending Home Loans and Popish Mortgage Group. Today is Tuesday, April 7th. I wanted to come to you and just give a kind of a quick update on a couple things that's happening in the mortgage industry so you guys can be kept up on all the updates and everything like that, some of which is going to be a little bit of a commentary that I'd like to put out. So just bear with me as we go through a couple different topics. The first topic I want to talk about is forbearance. That seems to be the word of the month, given what Congress did with the CARES Act. And a lot of people might misinterpret what a forbearance means or what a forbearance does. Understand that when your mortgage payments come due, they're still obligated to be paid. Okay, through the CARES Act, they do allow for lenders or mortgage servicers. Servicer is the company you actually pay your mortgage payment to. They do allow for a little flexibility from these mortgage companies to allow you to pause your mortgage payments. It's important to know that you're not skipping mortgage payments or that they're completely forgiving the mortgage payments that are due. They're just kind of putting a pause on those, again, through that word that we just mentioned called forbearance. A couple things you need to be aware of, though, with the forbearance is, first of all, the mortgage payments that are paused are going to be due at some point. And what I'm hearing is some mortgage servicers are saying, okay, we're going to give you a 2 or a 3 month forbearance to start. And at the end of that 2 or 3 month period, the amount of mortgage payments that you missed, they're going to be due at one lump sum. So, for example, let's just pretend for a moment that your mortgage payment is $2,000 a month and you were on pause, if you will, for 3 months. You were in a forbearance for 3 months. You're basically behind $6,000. Well, at month 4, that mortgage payment is due as well. And so if that's $2,000, you're basically going to have to come up with $8,000 to pay the mortgage company to get caught back up current. Okay. What some companies are doing, and rather than saying, okay, you need to pay us in one lump sum, they might say, okay, for that $6,000 that was in forbearance, what we'll do is we'll spread that out over a couple months, whatever that couple months looks like, right? So they might spread it out over 2, 3, 4 months maybe, which is great. But what that's going to do is it's going to increase your minimum monthly payment for that short period of time so that you can pay that back. Okay, keep in mind there's no such thing as free mortgage payments. Does not exist, unfortunately. The other thing that I'm hearing some mortgage companies do is they'll say, okay, what we'll do is we'll take the amount that was paused, if you will, that was in forbearance, and we'll tack it on in the form of a silent second mortgage. So what that means is at the point that you try to sell or refinance the property, that silent second mortgage is also going to have to be paid off. So in the example I just gave, if you were on pause for 3 months, that'd be $6,000. That would be, again, a silent second mortgage that would have to get paid back. Some servicers or mortgage lenders, if you will, could charge interest on that. It's all going to be dependent upon what agreement that you engage with your mortgage company. There is also talk of some mortgage companies saying, okay, well, we'll just tack it on to the end of the mortgage at the very end. In order for them to do that, or even with the silent second mortgage, quite frankly, it's probably going to require an actual loan modification. And the one thing that I would caution you on in engaging in a loan modification is many times those modifications or forbearances will have a negative impact on your credit. So, first and foremost, if you are unable to make your mortgage payment, what you need to do is contact your mortgage company and have an open dialogue with them and find out the good, the bad, and the ugly of what a possible forbearance is going to entail. Okay, please do not assume that you just don't have to make your mortgage payment, because if you just make that assumption, you're going to be negatively impacted, not only now, but for years to come with the delinquency reported on that credit report. Have that open dialogue and find out what the forbearance is going to entail, what the payback is going to require, and all that sort of stuff. That way you're walking into that with full knowledge, okay? If you are able to make your mortgage payment, please don't think of this as a time just to say, hey, I'm just not going to make my payments. If you have the means and ability to make that mortgage payment, you really need to do so. Because if too many people decide I'm just not going to make my mortgage payment, even if you have the financial means to do so, it's going to cause a ripple effect in our financial system that, quite frankly, none of us really want to see. So The responsible thing here at this point is if you have the ability and the means to make the mortgage payment, auto loan payments, whatever payments you might have, please continue to do so. If you are in a true hardship, which many of you are, have that open dialogue, have that open line of communication with all of your creditors, not just the mortgage company, but all of the creditors out there, so that you can be sure that you're protected. You're protecting not only today what your credit standing is today, but your future credit standing. So we just want to make sure that that's pretty clear. I know that there's been a lot of videos out there about that as of late, and I appreciate everybody putting that out there. We just want to make sure that we get the message out, the correct message out, that people don't dig themselves a bigger hole than what's absolutely needed. The other thing that I want to talk about, last week I saw some stuff out there online talking about doing refinances to pull cash out in lieu of a forbearance. And quite frankly, that might not be a bad idea. Depending on what your current loan situation is today, if you're working, a refinance could make sense. With interest rates being as low as they are, quite frankly, you could actually benefit from a refi. And if you have enough equity in your home to pull cash out, and at the same time of pulling cash out, lower that interest rate, so you kind of kill two birds with one stone, if you will, that could actually make some sense. But I would caution you on something. If you're looking at doing a cash out refinance and the interest rate on the mortgage is going to increase from what you're currently at, I'm not real sure that makes a whole lot of sense. Now, everybody's situation is going to be very different here, okay? But we want to make sure that whatever refinance you enter into is going to make sense, not only short-term but long-term. With doing business with us at Popish Mortgage Group, we use a lot of technologies to really look at the benefits, the cost versus benefit, if you will, of executing any type of refinance. So we can give you an honest assessment as to what that would entail. I do not recommend, churning mortgages, if you will. So churning mortgages means refinance to take cash out today, and then in 6 months refinance again. The only way that would make sense is if you're going to benefit in some way. And really the benefit, you'd have to again look at the cost versus the benefit to make sure that what you're doing is really making sense, rather than just fleecing equity out of your home, right? That's something we definitely do not want to do if it doesn't make sense. If you're already in a situation where the current first mortgage you have is extremely low and a cash out refinance maybe does not make sense, one idea could be to open up a home equity line of credit. Now, with that said, full disclosure, I personally do not offer home equity lines of credit. However, I've got some pretty good resources that I can refer you over to execute these for you if it makes sense, right? So basically what this would be is keeping the current mortgage you have intact, in place, not touching that, leaving that alone, and then going and getting just that home equity line of credit. The benefit of that is you're only going to pay interest on the amount drawn. So if you open up a home equity line of credit, but you don't draw anything against it immediately, you're not going to pay any interest. So really, that could be the most beneficial. But again, what I say is you need to talk with a trusted lender and make sure that they look at all options for you, not just a tunnel vision of maybe just one refinance. Maybe they look at all options there for you. So a couple things to consider there. The last thing I want to talk about is what's happening in the mortgage world as far as tightening up of credit standards and things like that. As you can imagine, what we're dealing with now is unprecedented. None of us alive, quite frankly, have ever dealt with anything like this. I personally have been in the business since 2003, and this is very reminiscent, or what I'm seeing in the financial world is very reminiscent of what we dealt with back in 2008 to really 2012, when we saw a lot of tightening in underwriting guidelines, credit standards, things like that. And I will tell you, we are experiencing that. What that means is higher credit score requirements, lower debt to income requirements, or lower allowable debt to income ratios, I should say. Possibly even in some cases, lower loan to value requirements, right? Anytime a lender does a mortgage, basically we have to assess risk, right? And so when we have times like we're running into, that risk threshold or the appetite for the higher risk loans tends to decrease. And so we see a tightening of underwriting guidelines. And we're experiencing that right now. But again, this is where it's important to talk to your trusted lender and make sure that the situation that you're doing if you're a consumer and you're trying to do a refinance, or maybe you need to buy a home, that you have the right program for your situation. If you're a real estate broker out there, again, talk to your trusted lenders, partners that you work with, and make sure that they're kept abreast of the various changes that are coming out into our market. Okay. There has been talk lately of FHA being in trouble. Currently, right now, we're still funding FHA loans on a regular basis, as well as VA, USDA, and your traditional conventional loans. Okay, the higher end mortgages, the jumbo market, if you will, this is any loan amount in excess of $575,000 here in the Denver metro area. That market is tightening. The reason it's tightening is because there's no backing by Fannie Mae or Freddie Mac with those higher end mortgage loans. So all those higher end mortgage loans, those jumbo loans, if you will, are effectively portfolio products for each individual bank or each individual lender. And as I said a minute ago, banks and lenders really have to analyze risk when we're looking at mortgage loans. And at the moment, many of those banks and lenders are looking at those higher end loan balances, those jumbo loans, as a little bit too risky for their appetite. And really what it boils down to is they just don't have the private investors backing them on the back end on the secondary market. So just know that we're going to continue to see things change on a daily basis. Some changes are going to be good, some changes are going to be bad, but we just have to adapt to all the changes. The days of saying, well, that's not how we used to do it, we can't really go by that anymore, just because we all have to be adaptable to what's happening in our market and our environment. The last thing I'll leave you with, and I mentioned this last week in my video, is, right now, going on the topic that I just talked about things tightening up, lenders are tightening up the length of time that we do verification of employments. So what that means is you're going to see a lot of lenders now re-verifying employment 2 to 3 business days before closing, maybe even 1 business day before closing. And the purpose of this is not to pick on anybody individually or anything like that, but we have to ensure that when we close a loan, we're closing that loan based on the most accurate information we have. If somebody is furloughed, laid off, or their hours have been significantly cut, they most likely won't have the same income level that they would have at the time they initially applied for the mortgage, thus making it impossible to approve that loan at those same terms potentially. So keep an open line of communication with your mortgage company, specifically your loan officer and loan processor. If something were to come up and you get laid off or furloughed, definitely do not keep that a secret. You need to pass that information along so that they can plan accordingly. It's important to know that closing on a mortgage loan, if you have knowledge that you don't currently have that same income or same employment, that leads down a road that most people don't want to go down. So I definitely caution you on doing that. With all that said, any questions you guys have, please leave a comment. Feel free to give me a call directly or shoot me an email. All my contact information is on my profiles, whether you're looking at this on LinkedIn, my Facebook business page, or my personal page. All my contact information is there. Feel free to give me a call. I'm happy to help answer any questions you might have or bounce any ideas that you might want to bounce around there. Thanks so much. Stay well, stay healthy. We'll all get through this together. Thank you so much.